interesting this week about my investing journey and how I've done something quite different to what most people do, which we'll get into now. So what happens when most people invest is they put a lump sum in, or they put money in for a few months, and then a crash comes and they panic. A lot of people sell it. I've got a good friend of mine who did this in COVID. He bought some stocks and shares. They did really well after the big drop of COVID, but then another drop come and he sold everything and panicked a little bit. And I think, you know, in hindsight, that was a big mistake, because we look back now, and if he hadn't done that, those funds would be way in excess of what they are now. And he put it back into typical savings accounts where he hasn't got anything like the return. And that's what most people tend to do. When they see the first crash, they panic. What I've actually done, and what served me really well, and COVID was a prime example of this, I actually doubled down. So what most people do, they buy at the height when the actual stocks are soaring, when they buy the stocks at their highest price, and then a crash inevitably comes at some point. What I've tried to do is, yes, I invest regularly, so every month I put money into the stocks and shares account, but what I've tried to do every time there's been a big crash is I've tried to put some extra money in. And I did that in COVID, and that's probably the reason why my portfolio is where it is. It grew significantly because of that lump sum I was able to invest when funds were almost on sale. Looking into a couple of scenarios just to see what the difference would be. So I looked at investing £10,000 in the S&P 500 over a 10-year period from 2015 to 2025, and what turned out was quite shocking. So firstly, if you put 10 grand in, you left it in there for 10 years and you did absolutely nothing with it, you would have in the region of £33,500. So, you know, 3.5 times nearly growth of your money for doing nothing, just leaving that 10 grand in there, which is pretty staggering in its own right. However, if you missed the best 10 days in the market, so the best 10 days were the biggest bounce backs in the market, if you didn't have your money invested in those 10 best days, your fund would drop to £17,500, so your money wouldn't even double in that 10-year period. So this just really goes to show how important it is not to panic when the drops, because those rallies often come after the drop. So that's why my theory is, and again, this is not financial advice, just what I'm doing personally myself, is I'm now trying to make sure I've got a few extra quid on top of what I invest every month to throw in when there's a big crash. You know, 10, 20%, whatever that number is, when that crash happens, I'm going to try and put some more money in, and we'll see how that pans out as we go through. Third scenario that I looked into was doing exactly as I just mentioned. So 10 grand in at the beginning in 2015, leave it there for the entirety, but after the 10 biggest drops, which I know we can't time the market, this is just for demonstration purposes, but if you were able to put an extra £1,000 in, so an extra 10 grand, so you're investing a total of £20,000 now over that 10-year period, that would result in £57,000. So I think that just goes to demonstrate that how powerful it can be, doing something different, not panicking when the market drops. And I think having a bit of a reframe or a change of opinion that, you know, when the market crashes, that's actually an opportunity. It's not panic, it's not fear, you don't need to sell everything. There's actually a massive opportunity to really enhance your portfolio and start investing more money doing it that way. So that's what I'm doing. Follow along if you're interested. It might all crash and burn and it might blow up in my face, but like I said, none of this is financial advice. But I've got just over £450,000 invested now, and I'm hoping to retire in the next 4 years.